Life is 10% of what happens to you and 90% of how you react to it. Did the recent sharp fall in financial markets represent a topping of the 2013 bull market, or was it a great buying opportunity? To answer this and other questions, I'm joined by two of the rising stars of the fund business whom I'd earlier profiled in the Wizards of Dalal Street, a fresh breeze. With me today, Taher Badshah, CIO of Invesco, and Manish Bhandari, CEO of Vallum Capital. Gentlemen, welcome to the show.
Thank you very much, Ramesh. Good to be back here once again.
Nice to have you. Taher, let me start with you.
Thank you.
This recent fall and rise, is it a buy the dips or sell the rallies type of market, according to you?
Well, I think it's buy the dips, clearly. I mean, we've seen this situation earlier as well. And so circle back to 2013, and it was a pre-election year, and we had this probably the same kind of problems, more or less. Investors, agnostic, and reasonable amount of pessimism, if not complete doom. And we had a few challenges around the macro as well as growth and so on and so forth. Maybe valuations at that point in time were a little more comfortable than what they are today. But by and large, anecdotally, similar kind of situation that we are in.
But did you feel that way at Nifty 10,000? I mean, now the market has rallied back. So did you feel that it was still a buy the dips market at 10,000 Nifty?
I mean, that's what our actions were, at least from the point of view of our funds and the way we conducted ourselves during that period. We were on the receiving side in terms of the flows. So to that extent, obviously, as a manager, we didn't have a choice but to deploy. We don't really take cash calls. So from that perspective, we were using those as opportunities. But we knew that even if things were to go wrong, we were not going to go to the cleaners from where we were at 10,000. So yes, maybe we would have seen another 5-7% downside. But beyond that, there was not really much to kind of lose. That's what broadly our analysis used to tell us.
Manish, let me get you in on the conversation. What did you feel? I mean, he clearly felt that was a buy the dips market. What did you feel?
The answer lies in what is the holding horizon on the review horizon of the investors. So you have investors who is 6-hour investors in India, and you have investors who are 10-year investors, and you epitomize one of them who we've seen a very long cycle. So if you are trying to distinguish between, if you're able to distinguish between your review horizon and holding horizon, obviously it's a great opportunity to consolidate your. And I usually, when I meet clients, I do tell them that if you have a business which is going to give you a very superior IRR than the equity market, what a manager is doing, he's just collecting your savings and deploying it in other businesses. So if you have a business which can deploy and which can generate far more better IRR and returns ratio over a period of time, please do that business and funnel back your capital in that. But if you have a business...
Excess capital.
Exactly, and you want to use the prudent way of diversification, and you want to have... And you can't be a partner in a business with a 2 lakh rupees or 3 lakh rupees. That's a wonderful mechanism for you to approach this situation. So all depends upon if your review horizon is half a decade or so, it could be one of the best opportunity. And I distinctly remember I joined one of my previous companies way back on May 2004. And that the sharpest fall happened when the government change happened. And I was worried because I was not on the right side of the age at that point of time with my experience. And that became one of the best investing opportunity maybe for a decade or so. So bull market does take a breather. And this is one of the breathers which bull market would consolidate here. And then you have a new journey and the new sectors and new formations which would happen.
You talk about breather, but one sector that has definitely taken a breather, Manish, is the NBFC sector. It's had a loss of confidence perhaps in the sector. What are the lessons you learned, and how has that shaped your view of the market today?
A bit lucky on the sides that we didn't invest in NBFC. But let me, if I have to look at the unfolding of this crisis, this is also a function of that. Is the crisis on the valuation side, or is the crisis on the business side, or on the crisis on the demand side? So I don't see any situation change on the demand side. What has happened is the market took a fancy for the growth and also the undominable position of the NBFCs and the monopolistic situation which many of them are going to enjoy because of the collapse of the other lending mechanism, and which led to finally a huge bull run in the NBFC market. And you'll always have in a bull run few people will fall off the way. But I don't see a situation where you have a systematic crisis in this NBFC. Good companies will come back in the fashion. But if you ask me whether the market has permanently shaved a portion of the valuation, answer is yes. So the crisis is not on the business side, but crisis was there on the valuation side.
Investors overpay for growth, and that's where the pain comes in.
There is is a debate, intersection of growth and value, and I think growth overtake value at that point of time.
Taher, in your former avatar, you used to do a formula called QGLP. How important is price in looking at the stock market? And was that the problem with the NBFC, that just people overbid for the value of those assets?
Yeah, so you put up a very relevant question, and that has probably been my learning over the last few years. So the additional learning that has come to me is that, as Howard Marks says in his book, Most Illuminated, that, there's no business which is so good that can be bought at any price and you can make money out of it. And there are no businesses which are so bad that if you pay a decent enough price, you can't make a return out of it.
A cigarette puff and a pipe, perhaps, the difference between the two.
It's more about what price do you buy things rather than actually just buying quality or low quality or high quality. It's also about what is the relevant price. Because ultimately, we are in the business of making returns. It is not about trophies that you want to collect and,
Great point. And of course, to give you an example to add to your discussion, 2003, Lever hadn't performed for 10 years. After you bought Infos at 2000, you didn't make money for the next 10 years.
Absolutely. And we saw it more recently in the case of oil and gas, for example. Reliance did not give any returns for 5 years or 6 years in a row.
Right.
And oil marketing companies were going through the roof. And then we saw a sudden reversal of trade in the last 2 years. So anybody who has been on the wrong side of that trade in oil and gas alone could have probably been off by about 5-6 percentage points in terms of performance over the last 1.5 years. So that's the magnitude of the problem if you are not cognizant of value or not cognizant of price, or maybe you put price in the very end of the equation.
Taher, let me take you out from the P part of the formula to another P, protectionism. Everywhere I see, whether it's recently in Mexico, whether it was in the United States, whether it's Brexit, whether it's countries in Europe, governments are moving to protectionists. 50 years of globalization seems to be reversing. How worried are you about that?
So it's worrisome. We are, as a country at least, we are not central to it in the sense that we are not amongst the nations who are the most benefited or the most hurt.
We are a domestic economy.
We are a significantly more domestic-oriented economy, and we are going to probably continue being that way. But at the margin, it does affect us. So, for example, the recent US-China trade standoff, we all would like to have believed that we are probably not party to this whole thing, and we will probably be on the sidelines. But it hit us in a different way, and it hit us to the currency route. So all the emerging market currencies during that period actually floundered, and India was part of it. And then oil took over, and that led to whatever happened in the rupee from there on. So it is going to come back to you as well. Nobody is going to remain insulated entirely.
No country is an island to itself.
Probably except for a Papua New Guinea or something.
Not in a globalized world.
Not in a globalized world.
Yeah, but Manish, that's the question I want to pick up on you. I mean, even a few years ago, if you listen to the talk shows, listen to financial channels, the one sentence that will always stand out is globalization is irreversible. And yet after Trump, it seems no longer so permanent. I mean, are you worried, and does that shape how you invest?
Yes, and very interesting question. The length of globalization debate and the benefit related to globalization has been 25 years since we started in 1992 accession of China in WTO 2000, and which was one of the biggest global event. Absolutely. And today we are in 2018. So if you look at a history of 25 years, what does finally the rise of Trump and Brexit tells you? It tells you one point, that the benefit of globalization is not evenly distributed. So democracy has to fight back for the evenly distribution of those benefits, and which has not happened. Essentially, it has gone to China, it has gone to the whole shift of production lines to the most efficient players, and finally someone is loser. And in Brexit there was one part of the loser, one part of the society was a loser. So obviously it is going to be, so deglobalization can be a thing, regional bloc can be a thing. Answer is yes, and we are seeing more and more, and it is getting expressed in the...
That's painful, right? I mean, it has to be painful for markets, deglobalization as you call it.
Yeah, this is painful. This is painful, especially for India, because we have started making our journey to get ourselves integrated into globalization from our export mechanisms, and over a period of time for our cheaper labor cost, and that is what we can offer to the overall system on the globalized pool. And when you see that the world is making a shift back on the globalization, it has gotten negative repercussions for India.
But Manish, you've also mentioned that whether globalization or deglobalization happens, the rise of artificial intelligence, the rise of robotics, the rise of machine is posing a huge threat to emerging markets, isn't it?
Answer is yes, and it is not particularly to the emerging markets. It is the rise of cheaper capital, which you can substitute from a labor point of view. So Japan has got all the, with the high saving rates, they have got all the reason and all the benefits to change the technological platform and get the gains out of it versus shift their jobs to the different part of the world. So it is a battle between the capital.
Rich countries and.
Yeah, it is a battle between the capital and the technology, which is gaining at this point of time. So there is too much of capital which will flow into technology, and that could change the equation. So yes, India and many of the labor-intensive sectors will be on the receiving end, until we are able to fight back with our increasing our R&D expense. If you look at China, would be close to 2% of GDP on the R&D spends, and India would be 0.5%, and I don't see enough incentive.
Television requires commercials. We'll take a break, come back and chat with Taher and Manish after the break.